Okay, boys. What I'll do is exactly what I did for the last solution. Is I'll do the workings here, okay, and then I'll post a separate video up on your Edmodo, um, talking you through the actual accounts itself. But here's just the workings for you, okay. Again, I've all the workings done out here, so calculations done to speed this up a little bit, so you're not being bored. Okay, so we'll open up the first working, okay, and it's a working on closing stock. Okay, your closing stock given to you at the end of the year is 38,200. Okay, but you had stock that was worth 8,200. Okay, it's now only worth 5,640. So the difference between those two is 2,560. That would be the loss in your value of your closing stock. So you take away that 2,560 because that is the amount of stock that's been damaged that you're going to lose. So that gives you a nice figure then of 35,640 euros. So that's your new closing stock figure. As you know, closing stock is needed in the trading account. It's also needed in your balance sheet and current assets. Okay. The next working then is you're working on patents. Okay. So they're given a figure of 63,000 in the balance sheet, but we know this is wrong. Okay. It's wrong because it's incorporating 3 months investment income. So what we need to work out is what are the 3 months investment income or investment interest. Okay, well, it's obviously, if you go back to your trial balance, you see that their investments is 6%, okay, of 200,000. And we want it for 3 months, we multiply it by 3 over 12, and that gives you a figure of 3,000. Okay, so as we know, we add that back onto your patents, so 63,000 plus the 3,000 gives you your correct figure for patents of 66,000. We're writing this 66,000 off over 10 years, so this year we're going to be writing off 6,600. That 6,600, okay, is a admin expense. The figure we're going to bring forward into our balance sheet is obviously the 66,000 minus 6,600 that we've written off, which gives us 59,400. Okay, and we know patents are an intangible asset in the balance sheet. Okay, the next working that leads me on to then, okay, is to work out what the story is with the investment interest. Okay, so we go back to investments, it's 6%, okay, of 200,000. We only had this for 9 months of the year because we took it out on the 1st, the 4th. Okay, so what we should be gaining from our investments is a total of 9,000 euro. So that 9,000 euro, okay, will go in as a gain in your P&L. Okay, now we have already received, okay, 3,000. That was included in our patents. That brings us down to 6,000. Okay, but if you look down there at working V, you see there at the very first one, investment income of 2,000 had been paid. So you've also received an additional 2,000 as well. Okay, later on in the year. So that brings us down to 4,000 that's due to us. If it's due to us, it's a current asset. Okay, and that takes care of your investment interest. The next working then is to do with a fire. Okay, was it a fire? Yeah, a fire. Okay, so we'll open up this here. Now, we've seen this before. You might be a little bit rusty with this one, so I'll slow it down just slightly. The first thing it says there, right? Okay, well, I'll read the full lot actually. During the year, a store worth 20,000 with goods valued at 15,000 were destroyed. Okay, so they're gone, finished. And then a new store was built, okay, using our own materials of 42,000 and labor of 18,000. Okay, so we have to take out that 42,000 from materials and we have to take that 18,000 away from wages because we're using it for our own benefit. And no record was made in the books of the old or the new store. And the insurance companies agreed to pay full compensation for the full loss. Okay, well, the first thing I would do is open up buildings. Okay, I probably should have that in red, but anyhow. Your buildings there, okay, if you go back to your trial balance, you always go to the cost, okay, is 480,000. And you had a fire, and you lost 20,000 due to the fire. Okay? Now, you built a new store, and the new store cost you 42,000 of stock, and it costs you 18,000 euro worth of labour. All right, so now your buildings is worth 520,000. Okay, so this here is a fire, this here is the materials, and this here is the labour. So you take away the 20,000 because you lost that due to a fire, so it's not worth that anymore. But you take materials of 42,000 of your own stock and you put that into the new building. So that has to be obviously what the new building is worth. And you don't forget that the labour that was put into it, there was 18 grand worth of labour put into the building. So that's additional worth towards the building. So your building is now worth 520,000. Okay, the next one I'll open up here, okay, is purchases. You go back up to the trial balance, you get the figure for purchases there for be 545,000. Now, what did we lose? Well, we lost 15,000 euro worth of stock, okay, due to the fire. We also took out 42,000 euro of our own materials to put into the buildings, okay. So this 42,000 belongs to here, okay. So we put that into the buildings, that's where you're taking out that 42,000. So that 15,000 belongs to the fire, that 42,000 belongs to your new buildings. Okay, I know there's another work into it, purchase later with the delivery van, as there always is, so I'm not going to close that off just yet. So the next thing I'll open up then is wages and general salaries. Sorry, wages and general expenses, I should say. Okay, because I have to deal with this. I have to deal with this 18,000 here, this lad. Okay, so my wages and general expenses, okay, from the trial balance that we're given at the start of the question is 148,200. I'm going to take away that 18,000. Again, there it is, that 18,000. So if you want, you can say that's to do with your, what the hell is that? Okay, if you want, you can say that's to do with labour. Now, that gives you 130,200. All right, so you can fire this off into your admin expense. The buildings, as you see later, lads, we'll use this again later because we're going to have a revaluation reserve. So there's no need to do anything with that 520,000 to circle it and say go to fixed assets, because it will not. Okay, the next part of that working then, okay, brings us on to working 7, which is the insurance aspect of it. There's no working to this, really. Okay, it's just important to note because you'd forget it. The 20,000 lost to the buildings plus the 15,000 lost to the stock gives you a total loss of 35,000, and that's going to be paid to you from the insurance. It hasn't received yet. It will be paid to you, therefore it's a current asset. Okay, so that can be a little bit tricky, lads, if you're out a bit of practice. The next 3 workings you'll do in your sleep at this stage, I'm sure. Okay, it's the depreciation on delivery vans. Okay, so you have depreciation, what do they call them here, motor vehicles, is it? I'll just go MVs for short. Okay, 3 little columns as per normal, kept, rid, and new. Okay, so we kept 150,000 minus what we got rid of, which is 48,000. So that gives you 102,000 for the full year. And the depreciation rate is at 20%, that gives us 20,400. Okay, 48,000 multiplied by 20% multiplied by 3/12. Okay, and that gives us 2,400. The new vehicle, which is 54,000, by the 20%, we had it for the rest of the year, which is 9 months. Okay, that gives us 8,100. Add those 3 together and you get 30,900. Okay, there is your selling and distribution expense for your depreciation on motor vehicles. Okay, next part of this working then, working 9, was did we make a profit or loss on disposal? Right, so we got this vehicle back in the day, on the 1st of the 9th 2010. We had it for all of 11, and then we got rid of it on the 31st of the 3rd 2012. So that means it's 48,000 by 20% by the length of time we had it for the rest. 2010 would be 9, 10, 11, 12, which is 4 months. Okay, it gives us a figure of 3,200. In the year 2011, we had it for the full year. Okay, so that gives us 9,600. And for the year 2012, which is the year of disposal, we've already worked that out above, 48,000 by 20% by 3 over 12 gives you 2,400. And those three figures will give you your total depreciation accumulated on this motor vehicle, which is 15,200. Now, if the vehicle cost us 48,000 and our accumulated depreciation to date is 15,200, well, the net worth or the net book value of this motor vehicle is 32,800. If you refer back to the working, you'll see there that the allowance given to us by the garage is only 31,000. Therefore, we got less than what we thought it was worth. Therefore, we've made a loss on disposal of 1,800. Therefore, that's a selling and distribution expense. Loss on disposal. Okay. The next part of that working 10 is the balance sheet. Okay, so motor vehicles in the balance sheet. Okay, we've got both the cost and depreciation. All right, well, on colour, €150,000 was cost minus 48,000 plus 54,000, which is just an increase of 6,000, so it's 156,000. The accumulated depreciation back in the trial balance gives you 54,000. We got rid of that vehicle, and the accumulated depreciation of 15,200 goes with that, and the depreciation charge for the year that we worked out in working 8 is 30,900. And that gives an accumulated depreciation to date of 69,700. Both of these will go into your fixed assets in your balance sheet. Okay, we can move on to the next working. Okay, it is the bank comparison. We'll move on to a new page for this. Okay, so this is working number 11. So this is our own bank versus the bank statement. Okay, there's a few discrepancies, so we're just got to fix them. All right. Okay, well, our own bank, if we go back to the trial balance there, about halfway down there, you can see that we have an overdraft of 6,800, and the bank statement that arrives gives an overdraft of 2,070. Oh, it's just after popping into my head there. Okay, I must go back to delivery vans. Okay, and I need to go back to purchases. Okay, and I need to take away how much I actually paid for the van. If the van cost 54,000 and they gave me the allowance of 31,000, the difference between the two, okay, simply 54,000 minus 31,000, which gives us 23,000. Okay, so I can subtract that 23,000 from here. Okay, I'll just put that there, front motor vehicle. All right, and that gives me 465,000. Now, that's that closed off. And that, as we know, purchase goes to trading account. Always forget it. All right, back to work in 11. So we've got our own bank versus the bank statement. And the first thing we see here is this investment income had been paid directly into our bank. If it's been paid directly into our bank, it's positive. So that is already taken care of because we've taken care of investment interest in a previous working. A credit transfer of 600 had been paid into our bank. Lovely. So it's another positive. This is to do with a bad debt. Okay. We will do a work on that after we sort out these discrepancies. A check issued for 1860 had not been presented for payment yet. So that is another minus 1860, as it's going to increase our overdraft in the bank statement. A check for 1250 issued to a supplier had been recorded, okay, or entered as 1520. So too much. Okay, therefore we need some of that money back. Okay, so we're going to have to do a little bit of work on that. The difference between 1520 and 1250 is €270. Okay, the check was only for 1250, but we put it down for 1520. So we took too much money out of our bank account, so we're giving a little bit back. Okay, the difference back, which is 270. That works out to be an overdraft of 3930. And if we come over here, you will see that it also gives you an overdraft of 3930. Therefore, discrepancy sorted. We can now safely say, well, that is what your bank balance is, which is a 3930 overdraft. So it's a current liability. So the first thing we'll fix here is this 600 to do with a bad debt. So, bad debt, because we're not getting this money. Okay, this €600 represents 30 cent in the euro, which basically represents 30% of the bad debt. Okay, so 600 divided by 30 multiplied by 100 will give us the full debt, which is a handy number to have. So that's the 2,000. They've given us 600. Okay, so the difference is what we have to write off. So that 1,400 there is what we have to write off. So that's your selling and distribution expense. Okay, we must go into our debtors then, and we must adjust our debtors. So you go back to the trial balance. Okay, your debtors figure there is 46,000. I'm going to subtract the full 2,000. The full 2,000 is both your 600 that you received plus the 1,400 that written off as bad. So that's 2,000 there. Take it away from 46,000, it gives you a new figure for debtors, which is 44,000, which we know is a current asset. Okay, so that's that. 600 taken care of. Now we must work with this 270. Okay, if we think about it, we thought we paid off more than we actually did when it came to creditors. We thought we paid off 1,520. We didn't. We only paid off 1,250. So we reduced our creditors by too much originally, so we need to add the difference back onto our creditors. So the creditors there, if you go back to your trial balance, is 38,100, and I need to add on that 270. I need to increase that liability. Now it's gone up to 38,370. And that there is obviously a current liability. Okay. And that takes care of the discrepancies in the bank accounts. Moving on to the next one there, working, I'll do it in red, keep the same order. Okay, working 15. Okay, depreciation on buildings. Okay, in this case here it says at 2% of cost. Land at cost was 80,000, so we must take away that 80,000. Our buildings, if you remember, okay, we had to adjust it due to the fire. There you have it, our buildings there is that figure there, 520,000. So we're going to take that figure, okay, back here. So 520,000 and take away that 80,000 because that's land. Okay, and that gives us a figure of 440,000. I'm going to multiply that at 2%, and that gives us 8,800. So that's your depreciation charge for the year on buildings. So that's an admin expense. Okay, now it was decided then to revalue these. So we've got a revaluation reserve. Okay, so if we take our 520,000, we've got our accumulated depreciation given us in the balance sheet there. Okay, the difference between 480 and 444, and that gives us 36,000. We must also take away this year's depreciation of 88, and that gives us a net worth at the end of this year of 475,200. Okay, but we're going to be told that we have to revalue these, and revalue them up to 660,000. So the difference between the two, lads, is your revaluation reserve, which in this case here is 184,800. And that will go into your finance by in your balance sheet. All right. Now, the next working gentleman, okay, which is on dividends. You'll be delighted to know, I think since 2012 is no longer on the course. So my apologies. I should have read this question properly and fully before giving it out to you. Okay. However, it's not that difficult, so I might as well just show you it so you can understand the account itself. Okay, so here's what happens. Okay, so we're just going to sort out our dividends. Okay, let's start with the preference because it's easier with the preference, to be honest, right? So your preference dividends here is a percentage. Okay, your preference dividends is 8% of 220,000. So if I go 220,000 and I multiply that by 8%, all right, that means I'm going to get 17,600, okay, of preference shares. I have to give, 17,600 of preference shares for the year. An interim dividend basically means, if you see it, it's just about 2/3 of the way down there. Interim dividend for the first 6 months, 22,400. So I'll write that down over here, right? I suppose over here. That is your interim dividend, all right? Okay, your interim dividend, that 22,400. All right, for the 6 months. So your preference shareholders will get half of what they should get, okay, after 6 months. So 17,600 divided by 2 gives you 8,800. So if I divide that by 2, it gives you 8,800. So that's what they've been paid already. Okay, so what's due to them? Well, obviously it's the remainder. 18,800 is what's due. Sorry, 8,800 is what's due to them. All right, so that's what's saying here. Okay, preference dividend to be paid. Okay, due to be paid. So that's 8,800 is due to them. Okay, now let's look at the ordinary shareholders. What do they get? Well, if the interim dividend was 22,400, okay, so that's what your interim dividend was that you gave out, was 22,400. Well, from that you paid 8,800 to your preference. So obviously the balance is what you gave to your ordinary shareholders. Okay, 22,400 minus your 8,800 leaves you with 13,600. Ay, ay, ay. Okay. Okay, so 13,600 was given to your ordinary shares. So that's been paid, okay, to your ordinary shares. Now, it says here in the workings, okay, bringing the total to 7%. Okay? Now, 7% is got from your ordinary shares. So you've issued 420,000 euro worth of ordinary shares. So 420,000, I'll do that out here actually. So 420,000 multiplied by 7%, okay, will give us 29,400. We've already paid 13,600, okay. I need to take away 13,600 from that, okay, and that gives us 15,800 is what's due. Okay, as I said, this is no longer on the course, lads, all right, so you don't have to worry about it too much, but it just makes it easier to understand, okay, when you're looking at the accounts itself. So, just to recap, okay, paid already, okay, because it's half of 17,600, that's what they are guaranteed to get at the end of the year because of preference. Half of it was paid out already after 6 months, 8/8, so they're going to get the remainder now at the end of the year. If we take what we paid away from, where does that figure go? Okay, magic. What was that figure there in terms of dividend? 22,400. Okay, that 22,400 there is what they got paid after 6 months. So we take the 8/8 from the 22,400 and you're left with 13,600. So that's what the ordinary shares got. All right, we want to bring up the ordinary shares so a total of 7%. 7% of 420 is 29,400. Take away what they've already, that's what happened. Take away what they've already been paid, which is at 13,600, and the balance left is 15,800 what's due to them. All right, so that explains the dividends. All right, no, we're nearly there. All we got to do is take care of the debenture and our provisions for bad debts. Okay, so working 18, debenture interest. Really straightforward, boys. Fly through this fee. All right, be careful now because there was an increase after 3 months again. So 8% of 120,000 for the first 3 months, okay, and then it's 8% of 160,000 for the remaining 9 months of the year. Okay, that gives you 2,400 and that gives you 9,600, giving you a total of 12,000. So that is your penal expense, lads, okay, for debenture interest. We know where that goes. You can see there the last line in the trial balance, we have received debenture or paid debenture interest the first 3 months, which is 2,400, which means that 9,600 is, of course, your current liability. And the last working, boys, working 19, okay, is your provision for bad debts has been changed to 5% of debtors. Your debtors figure, your new debtors figure taken back from your previous working is 44,000. I'm going to multiply that by 5% and you get 2,200. The old provision is 1,600, so the difference between the two is 600. So that there, lads, is a selling and distribution expense, and we know that that 2,200 is going to go in your current assets when you take it away from your debtors. All right, boys, there's your workings.